The broadcast is now starting. All attendees are in listen-only mode.
Hi everyone, welcome to today's webinar. My name is Ashley Simpson and I'm going to be moderating today's presentation. I am going to give it just another couple seconds. It looks like there's some people jumping on, so we will get started here shortly. All right, let's go ahead and get started. So again, my name is Ashley Simpson. I am the marketing manager for RMC Group, and today we are going to be talking about the hardening insurance market and where the market is heading. So today on the webinar, I have Courtney Bowles as our guest speaker, and I'm very excited to have her here today. So Courtney has only been with RMC for a few months, but she's been in the captive industry and the insurance industry for quite some time. So she's got a lot of expertise, and I'm very excited for her to talk to you guys today about this topic. So a couple things before I hand it over to Courtney. I just want to let you know the microphones have been muted today, but we will be stopping throughout the presentation to ask any questions. So feel free to use the chat or the question box if you have any questions, and we will try to answer those throughout the presentation. Again, I'm very excited to have Courtney. She is out in Arizona. She has clients throughout the country though, but she is our captive risk manager. So I am captive risk consultant, sorry. But I am very excited to have her present today. And so I will go ahead and head it over to Courtney.
Thank you, Ashley. I'm excited to present today as well. And thank you to all of you for joining us as we talk about how to soften the blow of the hardening insurance market for your clients. Today, we're going to review the state of the market, how you can adapt to it, and probably most importantly, why you should. The goal is to better understand where we are, to see these challenges as opportunities, and to know that you're not alone and that RMC is here to help. This is what a hardening insurance market looks like. The key feature of a hardening insurance market is that premiums are going up. Prior to roughly around 2019, as you can see, rates had decreased. In fact, rates had actually decreased by 30% since 2003. So we've been in what's considered a soft market for a long time. The market is now hardening. What does this mean? It means we're seeing increases in premium, 24% for property, 8% for general liability, anywhere between 30 to 60% for umbrella, and 28% for financial liability type policies like directors and officers, employment practices liability, cyber risk. There's a small bit of good news. Workers' compensation is seeing a 3% decrease in rates on average. What percent of clients are being impacted by these increases? The majority. 89% for property, 65% for GL, 76% for umbrella. 100% of clients, according to this study, saw increases in their directors and officers rates. That 3% decrease for work comp, though, at least half the clients are benefiting from that. So again, a little bright spot. Why is insurance getting so much more expensive? We're going to discuss 7 reasons why the insurance market is getting more expensive by the day. The first is that the insurance market, like any market, is cyclical. Those of us in the industry have actually been waiting for the market to harden for a very long time. The next reason is that we've had an above average incidence of natural disasters. We are now into the Greek names for hurricanes this year. And the states out where I am Colorado, Arizona, California have been absolutely ravaged by wildfires. These kind of natural disasters cause the market to harden. There's a fluctuating stock market. Insurance companies invest, and like the rest of us, they're not totally confident in the market today. They do have to be conservative in their investments, but they are often in the market. One thing that has changed, though, in a traditional hard market, it's a reduction in capital and capacity that drives it. The current market is being driven in part by the insurance company's desire to make a profit through underwriting. This isn't something that typically happened in the past. Typically, they charged $1 of premium, and they expected to have $1.03 of losses, and that was okay because they were going to offset that with investment income. Now, underwriters are expected to charge $1 of premium and only have 97 cents of losses so that they can make a profit. They're essentially being asked to sharpen the pencil. There are a number of ways they can do that, one of which is to reduce their variable expenses and cut down on losses, which means that they can add exclusions into the policy so that there aren't as many losses. Another way to do that is reduce the fixed expenses of the insurance company, which isn't something they can do easily right now, particularly when they still have commercial building leases and employees working at home. And then the final way to make more profit is simply to charge more premium, which is what we're seeing a lot of. The fourth reason for the hardening market is low interest rates. Insurance companies are required to invest conservatively. The challenge for them is that the good stock market we're seeing has also meant low interest rates because they run it at inverse. So those safe investments that they typically make are simply not paying out as much. Some reinsurers have deliberately modified their investment guidelines over the past decade because of these low interest rates. It's been said that investment in risky assets has risen from just over 5% to 13% by the end of 2019. So the low interest rates are driving a hard market because they're in riskier investments and there's less money to be made in the conservative investments. Social justice movements have impacted the insurance market in ways we might not actually think of. One of the things that has been happening recently is companies are being sued for lack of diversity. They may have an on-paper diversity plan, but if that doesn't show throughout their company and their board isn't diverse, lawsuits are being filed against them. Companies that have seen this in recent months include The Gap, LifeLock, Qualcomm, Facebook, and Oracle. The social justice movements can also lead to employment practices liability suits if there's wrongful terminations. Regardless of the results of these suits, the insurance companies are going to have to pay to defend themselves. So they'll have to reserve funds aside and they'll have to pay for the litigation. COVID is the clear major factor in all of this, the one I felt like I barely even need to touch on because it seems so obvious. It's impacted all of us, including the insurance industry, with the shutdown of the economy, health issues caused by people delaying routine care, mental health issues caused by the stress, and certain things that are fairly insurance specific. There might be additional workers' compensation claims going forward as companies are required in some ways to protect their employees from contracting COVID. One way they're doing this is testing, and that may also create privacy issues as they collect data that's considered sensitive that they're not used to having. The property and casualty insurance industry's net income dropped 26% in the first half of 2020 as the effects of the COVID began to hurt underwriting. One offshoot of COVID has been the transition of employees to work from home. This happened fairly suddenly, and many companies are concerned about their cyber risk because they didn't have time to implement systems and test them out. It also has an impact on employment practices issues because certain things like employees logging their time correctly are more difficult to monitor when employees are working from home. There's a potential for poor ergonomics from workstations being set up at home, causing workers' compensation issues. And then again, there is the mental health of the employees as they're isolated, stressed, handling their children's schooling at the same time, and worried like the rest of us about their health and the economy. And the final factor is rising healthcare cost. This has been going on and it continues. For most middle market companies, group medical benefits are the second largest expense after payroll. So when there are continued increases in the cost of group medical benefits, it hits companies hard. What does a hard market mean for your clients? It means that they will be offered policies that cover less but cost more. It also means they'll have less options to choose from. So if you're an insurance broker and you're going to shop the policy for your client, it may not have as many places that are interested, or those places may be charging more or putting more exclusions on it. Besides the hardening of the insurance market, what else is going on out there? Unfortunately, many clients are finding out they didn't have coverage for things that they thought they perhaps did. Biggest example is probably loss of business income. In a traditional scenario, let's say a construction site has a fire. They might have coverage for not only the property damage, but also the loss of income while they couldn't work on it. But the fire is the trigger. Typically, insurance policies are written so that a physical event has to trigger this. With COVID, there was no physical damage to the property. So the restaurant was fine and could have been operating, but was required to shut down. Do they have coverage for business income? The lawsuits we're seeing coming in say no. In addition, after SARS in 2002 to 2004, a lot of policies wrote specific exclusions for communicable disease. So COVID is unlikely to be covered.
Hey, Courtney.
Yes, ma'am.
Oh, sorry not to interrupt, but you're probably going to get to this just based on the presentation, but someone just asked, so how do business owners in the future have some of these losses? How do they get them covered?
That is a fantastic question.
Does anyone know?
I can tease that one of the best ways is perhaps to do it yourself.
Okay.
So we will talk about strategies to deal with this, and I'll touch more on that for sure.
Perfect. Thank you.
Sure. Another thing we're seeing is that there are just simply exposures that insurance companies don't want. As the market hardens, the companies can dictate more what they want to write and what they do not. And anything that's systemic, they're unlikely to want to cover. Makes sense because it can hit every geographic location at once or every industry at once. It can have an impact across multiple lines of coverage. And if something is systemic, like COVID, the risk isn't just limited to the underwriting. Insurance companies themselves are impacted. Huge interruptions in economic activity, investment portfolios are affected. They're facing the same work from home as we are. It's been said that this is an existential moment for the insurance industry, where they can say, we're here to help policyholders manage their risk, or they can choose to say, we're just here for the easy parts, the manageable parts, and good luck with the rest. That's what's going on in the world of insurance. In the general world as a whole, we're seeing sales done in a whole new way. So if your client is looking at coverage that's more expensive or a claim that's not covered, you have to tell them, and you don't even get to share a round of golf to soften that blow. So where are we going? What's next? Honestly, no one knows. If there's one thing we've learned from this pandemic, it's that we didn't know what to expect. What we have seen is that insurance companies are not necessarily prepared to adapt quickly. The insurance market is typically not a forward-thinking, fast-moving, tech-embracing industry. It tends to be slow and want to be conservative. Might be a side effect of having a mentality of always thinking what could go wrong. So if the insurance industry is probably not prepared to adapt quickly, the bigger question is, are we? One good effect of all of this has been the emergence of enterprise risk management. This isn't just traditional risk management where you look to see what can be covered under a policy. This is risk management that involves the entire C-suite, not just the CFO or HR director, because the look is how the company operates overall. It's really a look at how you're going to choose to handle problems. Do we want to outsource or hire in-house? Do we want to buy an insurance policy or self-insured? Enterprise risk management also considers the impact and probability of a loss, not simply what we could have a fire, but if we had a fire, how quickly would we feel the effects? How widespread would it be? How long would it last? How are we prepared to respond? And what are we doing to mitigate this risk? So enterprise risk management is a more holistic approach to looking at the risk of the company. Before we move on to the strategies, Ashley, are there any other questions?
One question just came in about the enterprise risk management. It says, is this something that RMC can help me with, or how do I go about reviewing, or how do I go about doing this with my clients?
It is absolutely something that RMC can help you with. We can sit down and look with you at not just the insurance policies the client is purchasing now, but we can talk to you and them about what risks they have that they haven't addressed, what keeps them up at night. We can also look at their financial situation and strategies like pensions, life insurance, a really holistic approach to see what we can do to help them and partner together with you to bring those strategies to them.
Perfect. Thank you.
Sure. Let's talk a little bit about how we can succeed in this new market and how we can take something that's been a struggle for most of us and turn it into something good. The first is to embrace technology. You can sit at home and wish that you could get together with your friends, or you can get online and have a Zoom cocktail hour and make the best of it. Some good things on the side of an advisor. If you want to do a video, it no longer needs to be professionally done. You can embrace it and make one from your home. You can use this time to focus on the online experience for your clients. Can they reach you easily? And can they get the answers when they want them and from any device? And you can reach more of your clients than ever before. No, you can't go have lunch with them or play golf, but that time you're not spent driving means you can reach more of them faster. A second strategy is to do a comprehensive risk review, and this touches on the enterprise risk. It can start with something as simple as sitting down and looking at the insurance policies they're writing now. And then it can expand out to, like I said, how they want to handle risk. What's their risk appetite? What do they do when they have problems in the operations of the company? Are they likely to in-house it? How do they like to find solutions? RMC will do a free policy review for any client. So if you're a financial advisor and you want to partner with us for that, great. If you're an insurance broker and you're feeling particularly brave, we can certainly do that with you, and you can present to your client that you've given an independent review. This is a great opportunity right now to look at the risk based on where we are today, because policies that were underwritten extensively several years ago may not cover everything that's happening to the client right now. Another thing you can do to offset the increasing premium is to increase the deductibles. Typically, if the client is willing to take on more of the risk, then the insurance premium will lower. Similarly, on the employee benefits side, the trend has been to self-funded medical plans. This is an alternative to the traditional health insurance model and can potentially result in significant savings to the employer. It can also give them more freedom and control because they can work on the plan design and they can have better claims control and information about their risk. So what is a self-insured medical plan and how does it work? Essentially, rather than purchasing your typical employee benefits policy where I, as the employee, pay $50 deductible, and then somebody like Blue Cross covers everything else, the employer takes a layer above my $50 and covers that, and then they purchase what's called a stop loss policy to protect them against extreme losses. A lot of companies that have done stop loss, the employees don't even know because you still have a third-party administrator that provides services to your employee. So they're not involved in who's processing on the back end. But the employer takes on more risk and that results in lower premium. Let's look at a case study. This is a client that we did an evaluation for and looked at certain options. Their current plan was at 1.185. Their quote came in at 1.362. So RMC partnered with them to look at different options, one of which was a level funded plan option, which is sort of a hybrid between self-funded and fully insured. That was still 1.237. And then there was the option to do a self-funded plan. As you can see, it was a significant savings in premium. And even with the risk the employer was going to take on, the $489,000 of losses, and some administration costs for running the program, it still came in well under their current projected renewal on any other options, $889,000 compared to $1.3 million. The other great thing that happened for this client was that they used the savings that they had when they implemented the self-funding program to create additional programs for their client, for their employees' health. They were able to add an on-site clinic and to expand telemedicine, and that helped further reduce costs by roughly 15%. When a client does a self-funded medical plan, there was a cost you saw in there for vendors. And some of what those vendors do is provide wellness programs like screenings, lifestyle management, disease management, and health promotions. It can be weight loss cessation, it can be smoking cessation, it can be walking incentive campaigns. Another thing that you can do with a self-funded medical plan is get better data on your employees and the issues that they're facing. I'm not going to walk through all of this with you, but essentially this is an example of a care compliance plan that shows you who in your company has a certain disease and how well it's being managed. It's a dashboard to say, The folks who have diabetes are doing okay with it. The folks who have hypertension are not. And you can then tailor those wellness plans to help work with this, as well as get specialized resources to help your employees. It's not a HIPAA violation. You don't know which employees, but it gives you a good picture, or your client a good picture of what they have. And another benefit of a self-funded plan is that there can be pharmacy management. I think all of us are aware that prescription drug costs are a huge component of employee benefit losses these days, and that there can be extreme variation in the cost between where they're fulfilling the prescription or whether it's generic. So you can do a pharmacy management program as part of the self-funded medical plan. The final strategy for dealing with the market is one that can really tie all of these things together and encompass the enterprise risk solution I touched on earlier, which is to set up a captive insurance company. This is a company that insures the risk of its parent and affiliates. So if I run a manufacturing plant, I can set up an insurance company and design the coverages to cover the risk of my manufacturing plant. This is a regulated insurance entity by the state or country it's formed in, but it works for the client and allows them to see the profits from good risk management, gives them data to illustrate areas of improvement, and a way to save and invest those funds for the unexpected. What type of risk can you put in a captive? Nearly anything, but it depends on your size and scope. But some of the most successful things that we see clients using captives for are deductible reimbursement. I mentioned earlier that you can take on a higher deductible. If you set up a captive insurance company, you can write a policy for deductible reimbursement so that you're setting aside funds for those deductible losses, but you're also able to invest those funds in the meantime. Another thing that we've seen being very effective is to write a difference in conditions policy. We touched on the business interruption. I have done numerous captives over the years where we write what's called a business income difference in conditions policy, where that requirement that there's physical damage to the location is removed. So if the client had one of those, they could have submitted the claim to their captive insurance company and gotten covered when the government required them to shut the restaurant down. And finally, with the enterprise risk approach, you can look at certain things that may not have been considered losses before and put them into a captive. A lot of captives will write a policy for administrative actions, which is intended to reimburse the business for fines or penalties levied by a government agency. I've gotten several articles recently letting me know that OSHA has already levied $2.5 million in fines to various businesses failing to protect their workers against COVID. That's an administrative fine that could be reimbursed to the business by the captive. Here's a sample of lines of coverage that can be written in a captive for a client. As you can see, they had some of the enterprise risk type, the administrative actions, the loss of key contract, and then some difference in conditions for their environmental liability, GL. A case study that I've seen was we wrote a manufacturer of household products in California. They had a number of issues that weren't being properly addressed by their commercial insurance program. One of which was the difference in conditions in business interruption. They didn't have any damage to their particular plant, but the port they received shipments from was closed. And so it cost them extra expense to get their product on time. This was during the Occupy movement. And they had to pay extra It wasn't covered by their property policy because it wasn't damage to their business, but it was certainly a loss to them. They also had issues with intellectual property and copyright infringement for the items they were doing and the marketing they were doing for them. In California, they had a serious concern with regulatory change issues. California is somewhat notorious for labeling requirements and changing those labeling requirements. And every time they did that, our client would have to redo all the labeling on their products, which adds up over time to be a fairly reasonable expense. So by writing a policy for regulatory change, they were able to consider that a claim and both track it and get reimbursed out of their captive for it. Finally, one of the things we wrote for them was product service rework. Much of what they were selling was imported from China, and sometimes it had to be modified to be compliant because it simply wasn't what they ordered, but there's really no recourse to go back to China and get a better batch. So they would simply have to modify it themselves, do rework on it. And that was something they could put through the captive. Good potential clients to set up a captive insurance company and do it themselves typically have gross annual revenues in excess of 15 million, a need for property and casualty coverage and risk management, and they have to be sophisticated enough to understand and leverage it and have an appetite for it. I talked earlier about enterprise risk management. There are some companies who simply don't want to take any risk at all. They are probably not a good candidate for a captive. And then there are other companies who say, bring it on, because no one can do things better than I can do. And so I would love to be able to handle more of this myself. Manufacturers, construction companies, mortgage companies, physicians groups, utility, oil and gas, food distributors, all of these are great captive clients. So as you are talking to your clients and thinking about solutions, this is one that you can offer to them. And the reason we have the $15 million in there or employees of 50 or more is really because there are costs associated with it. And so it leverages out better at that point. But if you have a client who has significant risk that's just simply not being addressed in the insurance market, talk to us because it might be something that would be worthwhile for them because of that. It was asked earlier what we could do to work with you. And here's an example of RMC's approach. You can see we have risk management solutions like a captive or an enterprise risk management review, property and casualty, medical like the stop loss, business planning, the life insurance policies I mentioned, retirement solutions like defined benefit programs, and then business operations solutions like handling payroll or HR. So in partnering with RMC, you can create a comprehensive enterprise risk management strategy all with one place. Ashley, are there any questions about these strategies?
I had a question, I think it was back about the risk review. I didn't want to interrupt you, but it said, how long does the review take?
Good question.
Yeah.
One of the biggest challenges on that is simply getting all the information from the client.
Right.
So if you're partnering with us as their broker, that makes it a lot easier for both of us because you have the information. And Ashley, I'll let you talk a little bit more about how long it really takes because I think you've seen more of them go through RMC than I have, certainly.
Right. So it really kind of what you're talking about. I mean, I think it kind of depends on how quickly we get all the information, how long, and it kind of depends on too what the business is and how large the business is. But as far as I understand, it can take as little as 2 weeks, and it could take, longer than that, depending on, all the different factors that go into the business and how large the business is and how quickly we get the information. So I think they can be done fairly quickly, but it all just kind of depends on the situation.
Okay, great. Are there any other questions?
Not at this time.
Okay. Now, I mentioned that we need to talk about why you should do this. I'm not naive. I understand that if you are an insurance agent or broker and you take some of the policies and write higher deductibles and lower the premium, or you move the risk into a captive insurance company, you're potentially going to lower your own commission. I jokingly said that some of us have been waiting for the hard market for a very long time. There are insurance agents who've been waiting with excitement because higher insurance premiums mean more commission for them. But the number one reason that you should do this is because it's the best thing for your client. If you look at the strategies and it's better to have them set up a captive or do stop loss, then that's what you should do. If you don't do that, there's probably someone who's going to advise them on the option, and you might lose them as a client entirely. So it's better that you bring the one that be the solution. And there are definitely benefits to you to offset that lost commission. So let's talk about those. You get a better overall understanding of their risk. Typically, when a client talks to their insurance agent, they present a fairly rosy picture because they're trying to avoid increasing their premium. When they get on the phone and start talking about a captive and what keeps them up at night, they'll often share risks that they haven't shared before, or things they didn't consider to be manageable losses before. I have seen clients go through a captive type risk review and end up buying more policies in the traditional insurance market because for years the broker's been trying to get them to buy D&O or to buy reputational risk, and they've refused until they start to really get a sense of the kind of impact it could have on them. If you use the strategy of embracing tech, that allows you to get more updates on what's going on with them, to get those more quickly, hopefully not 3 months after they've made a huge change to their business, and to integrate them more easily. The better you understand the risk, the better you can manage them. It can help you understand how they prefer to operate and the goals for their business, creating an enterprise risk management approach, which takes you from salesperson to advisor. You become someone whose opinion your clients respect, who they ask for advice, and who's valued for knowledge. You're not just the lowest rate that they can get. As a risk consultant, you may be able to charge fees for this consultation, and this can be an additional source of revenue. You may have opportunities to cross-sell other products that your firm offers that you haven't before. And you might have a chance to look at other businesses they have that you don't write for. For example, I worked with a broker in the past who wrote a physician's risk for the neonatal clinic he had, very specialized, extremely high risk neonatal service. Turns out he also had a farm and a winery that they weren't writing. When we were doing the enterprise risk review, we found that out and they were able to quote on those. Going from being the person who comes in and offers premium, a commission commodity type vendor, to an advisor creates stickiness. I hike a lot. These are jumping cholla, and they're the reason I hike with tweezers and a comb, because if one of these gets on you, it is really hard to get off. And the reason for that is because it'll attach at one point to your ankle, and then when you go to grab it to take it off, it attaches to your hand. And if you try and kick it off with your foot, it attaches to your foot. This poor man is in a world of hurt. So stickiness can be created with your client if you become a trusted advisor with a numerous amount of strategies for them. Your client might get a quote that's way lower than yours, but then they think, but this other agent doesn't know about my captive, and I'd have to get them all integrated. Never mind. Or they get a quote and they think, this new person doesn't really understand how we like to do things and what this would mean for the other aspects of my company. So I'm just going to stick with my trusted advisor because he gets us. Another benefit to you as the advisor is that you have a variety of strategies to offer them. Offering a stop loss program or a captive or a comprehensive policy review is a way to get in front of your client with a new idea. And you can design a program that fits their needs. It's not just a one-size-fits-all approach. It actually helps their business, and they can feel that. That's the way that the world is going, because there are lots of options out there that people can easily get to, so it needs to feel personalized. An example of that I like to use is how we get the news now. It used to be that if you wanted to find out what was going on in the world, you better be ready to sit down at 6 p.m. with your family and Dan Rather and have him explain to you what was going on. Now, at any time of day, anywhere you are, you can simply pick up your iPad or your phone, and your news feed will present the information to you at the time that's convenient for you. And not just the time that's convenient for you, the information that you want to see. And so using these strategies benefits you as an advisor because you are now coming in with an adaptable, personalized approach. As you're working through the market, there are going to be some resources available to you. But before we get into those, Ashley, are there any other questions?
Not at this time.
Okay. We're going quick. We're almost to the end. Resources available to you out there as an advisor, probably sitting in your house like the rest of us, feeling slightly isolated. Because of that, there are more information and networking opportunities online than ever. Some that I've involved in include Success Champions Networking, a Facebook group called Insurance Soup, an Insurance Nerd Slack channel, because like the rest of the company, I'm an insurance nerd, and newsletters like Captive Review, Insurance Risk Management Institute, Business Insurance. There are also industry groups. It might be online, but there are ways to get insurance information and find out what's going on. And there are a lot of places still doing conferences, they're just virtual. There's also niche support. As the world goes more digital and diversity is emphasized, there's specialty groups emerging to help you specifically. For example, I'm part of a women in insurance group that provides a little bit of support tailored to me and things that might be affecting me. And finally, the best resource you have is to collaborate with us. As I mentioned earlier, you're not in it alone. We want to work with you. We want to make you into a trusted advisor with your client, and we can partner with you in doing that. Ashley, are there any additional questions and comments?
Yes, there was one. I missed it earlier. There was one that came through. The actuarial study. Can you talk a little bit about that and how, like, is there still time to do all of this in 2020? I know we're already at, November 10th. Is there still time this year?
The answer is yes. If your client is looking to get a captive insurance company set up this year, we can do it, but we are all going to have to partner together and hurry.
Okay.
So getting that information is going to be crucial, and being able to meet together and discuss and pick a direction, it's going to happen fairly quickly, but it can absolutely be done.
Right. Okay. Good. I don't think I see any other questions. I'm trying to scroll and make sure I didn't miss any. So yeah, I think, thank you so much for all of this information today. I felt like it was really helpful. I know for me personally, it was helpful just to hear all of that. So I hope that everyone enjoyed it today as well. If there are any further questions, feel free to drop them in the chat really quickly. But as we wrap up today, I just want to remind everyone, as Courtney just said, thank you. Here is her contact information, but we are here almost at year end. There is still time though. So feel free to reach out. We do actually have a brand new website. So if you go to rmcgp.com, you can view our new website and blog. So we have lots of information on there. Very excited that we just launched our new website. But it is year end. There's still time though. We are here to help. So please contact Courtney if you have any questions about today's presentation or just captive insurance in general, or really just anything that we can help with. We're here to help, and we're very excited. So Courtney, did you have anything else you wanted to add?
That's it. That's my cell phone number and that's my email. So anything I can help you with, including if you're just having a really rough day out there by yourself, feel free to reach out to me.
Yes.
Thank you all.
Thank you all so much today for joining us, and please keep an eye out for some of our other emails. We've got a pension webinar coming up next month, early next month, as well as some other, just news throughout the end of the year. So if you need anything, feel free to reach out. Thank you everyone for joining.
Thank
Bye-bye.
you.